The specter of a bank collapse is a scenario that holds a significant amount of dread for the average person, evoking images of long queues outside closed bank doors, the struggles of the Great Depression, and more recently, the global financial crisis of 2007 to 2008. When a bank fails, it can have far-reaching consequences, not only for its customers, but also for the broader economy and the financial system as a whole. Understanding how such a collapse could affect you is crucial in navigating the complexities of modern financial life. The mechanics of a bank collapse. To understand the fallout of a bank collapse, one must first understand how banks operate and how they can fail. Banks are the bedrocks of the financial system, taking in deposits, providing loans, and facilitating transactions. Essentially, they operate on a fractional reserve system, meaning that they keep only a fraction of their deposits as reserves and lend out the rest. When a significant number of customers demand their money back at the same time, a scenario known as a bank run, a bank may not have enough liquid assets to meet these demands. If the bank cannot quickly recover funds from its loans or sell its assets at fair prices, it may fail to meet its obligations. This could be precipitated by a loss of confidence by depositors or by large-scale loan defaults. Immediate effects on consumers. For customers of the failed bank, the immediate impact can be distressing. Access to deposits. The most direct impact on consumers is the loss of access to their funds deposited in the bank. While governments often insure deposits up to a certain amount, for example, the Federal Deposit Insurance Corporation, FDIC, in the United States, insures deposits up to $250,000 per depositor per insured bank. For each account ownership category, accessing those funds can take time. Amounts over the insured limit could be lost entirely, which could be devastating for individuals and businesses alike. Loan obligations. If you have a loan from a failed bank, you are still required to make your payments. However, your loan may be sold to another institution, and the terms could potentially change, especially if the loan was with variable rates or there were specific agreements with the original bank that are no longer honored. Payment and services disruption. A bank collapse can disrupt its payment services, such as standing orders or direct debits, which can result in missed payments for utilities, mortgages, or insurance, potentially leading to fees or loss of service. Wider economic effects. The fallout from a bank collapse extends far beyond its direct customers. Loss of confidence. The failure of a bank can lead to a loss of confidence in the financial system. This can cause a domino effect where depositors from other banks start withdrawing their money, potentially leading to more bank failures. Credit squeeze. Banks play a critical role in providing credit. When one fails, there is a reduction in the lending capacity within the economy. This can result in a credit squeeze where both consumers and businesses find it harder to get loans, leading to reduced investment and spending and potentially causing an economic downturn. Investment losses. Shareholders and bondholders of the failed bank can lose their investments. This not only affects wealthy individuals and institutional investors, but also ordinary people whose pension funds may have invested in such financial instruments. Employment. A bank collapse can lead to job losses, both directly within the failed bank and indirectly in businesses that relied on it for financing. This can exacerbate an economic downturn and further reduce consumer spending. Government resources. When a government has to intervene to ensure deposits or bail out a failing bank, it can strain public finances. Such interventions often involve the use of taxpayer money or the diversion of funds from other areas of public spending. The long-term impacts of a bank collapse can be profound and can contribute to structural changes within the economy and the banking sector. Regulatory changes. In the wake of bank failures, regulations often become more stringent to prevent similar occurrences in the future. While this can be positive for preventing future crises, it can also lead to increased costs for banks, which are often passed on to consumers in the form of higher fees and stricter lending criteria. Consolidation. Post-collapse, the banking industry often goes through a period of consolidation, with stronger banks absorbing the failed ones or their assets. This can lead to reduced competition, potentially resulting in higher costs for banking services and fewer choices for consumers. Innovation and fintech. A banking collapse often exposes the vulnerabilities of traditional banking systems and can act as a catalyst for innovation in the financial sector. This may benefit consumers by accelerating the adoption of fintech